Morning, everybody. How are we all doing? Who's here this morning? I can't see who's here because it's a member stream, so you have to let me know if you're here. If you're not here, don't let me know. But if you are watching on replay, questions in the comments or in Discord. Nobody's here, so I'll just talk to myself this morning. Right. Let's start off with the news. So this morning we're going to cover supply and demand zones, basically. Support and resistance, supply and demand, and what the difference is. So this is something that Morning Evil, something one of the members has asked me about, based on what I've been doing with the new EA that obviously draws in the zones. So I thought I'd cover it basically because it's a good question, what the difference is between support resistance and supply and demand. And there is actually quite a big difference. So a lot of the internet has recently gone mad about supply and demand trading. And while it's different to support and resistance, the concept is very similar. It's based on bank liquidity. So we're going to cover basically what the difference is between the two, how to identify them, and how to trade them with or without a stop. So that's what we're going to cover today. Morning, everybody else. Morning, Harold. Morning, Barry. Morning, FTNet. So we'll quickly start off with the news. Yesterday was obviously no news. Today we've had the cash rate for the Aussie, 4.35, came out as forecast, exactly what we were expecting. The Australians didn't mention anything else about increasing, decreasing, etc. Let me just go back and find it. There we go. So obviously with the rate announcement, we get the press conference. The press conference is where we get the forward guidance. Going to have to watch this later. But you're already here, Barrier Man. You might as well watch it now. That's fine. If you've got any questions, Discord or comments. RBA, basically, the upshot of what the press conference was about was that inflation is still sticky. There is not a very high likelihood of them dropping interest rates even early next year. So Q1 next year, February, is when their next plan interest rate adjustment is. And they're not planning to change. It's in here somewhere. It's not highlighted in red, but I read through it this morning. There's nothing. Inflation risks have eased, but they're not where they want them to be. So they can't drop the interest rates, basically. So the upshot is we should be seeing stable interest rates for Australia moving forward. No drops. So that kind of makes the Aussie neutral to bullish compared to other currencies. So we'll have to wait and see. But at the moment, that's basically what it is. Leaving for the gym. Very nice. Wish I was going to the gym. I go to the gym later. I do mine later, usually. I've given up my morning gym sessions because I find I get so tired during the day if I do morning sessions. It's much nicer just to smash it out at the end of the day. Anyway, so yeah, so that was it. Other overnight news, nothing particularly exciting. Obviously, there's a lot of stuff going on in Syria at the moment, which we don't know what is going to happen with that. But anyway, so that is your news overnight. Coming up today, morning CK, we've got CPI for the US. So this is obviously one of the most important news events we've got. Morning, Lucas. Forecasts are to come out roughly as expected with a small bounce potentially. So there could be some decent movement today on the US dollar. The overnight rate is coming out for the Canadian. That's going down to 3.25 forecast. That should happen as well. And then we get the press conference afterwards. So big day today for US and CAD. Anything from 1:30 to kind of 4 o'clock is when we're going to see most of the movement coming in on those two. And they will probably create a nice supply or demand zone, which we'll cover in a minute. So that's today's news. Nothing much else obviously happening today. This morning, I wouldn't expect a massive amount of movement on anything that isn't Aussie or New Zealand related. because obviously the banks and institutions are going to want to wait and see what happens with those Canadian and US numbers. So CPI, obviously one of the most important numbers, inflation, and interest rates obviously are what drives the market. So that's probably what we're going to see for the morning, and then 1:30 things will start to kick off. So last night I banked, yesterday I banked 1%, banked a load of Aussie before the news. This morning, banked a load of Aussie, New Zealand. I think it was, I'm going to have to look at what it was. I can't remember what it was. It was New Zealand, US, and pound odd. So New Zealand dollar, US dollar was trade from yesterday. So entry was there on the ADR reversal, straight out at target. And pound New Zealand, no, New Zealand pound odd was the inverse. So ADR 125 extension out this morning. So banked 0.4% this morning, sitting in 4% of drawdown now. Pretty much 3% of that is euro odd. So I unfortunately, annoyingly, missed an exit opportunity on this yesterday. So we were down here end of day, and I tried to close this trade out. It was about $150 or something. It wasn't a lot, but I wanted to close it out because obviously if it did do this, I obviously can then put it back on again. But it was literally 5 to 10, and I went to press the close button and market shut. So I didn't get to take it off, which is annoying because that would have been about 650 yesterday, but it doesn't matter. So yeah, so next entry is going in if we double top the weekly high there today. Euro New Zealand 125 ADR. So we've got a couple of ADR hits to look at, as you can expect. Well, it's all euro, Aussie dollar and New Zealand dollar. Yeah. So this move here that we're seeing is a knee-jerk reaction. There's no reason to be massively bullish or bearish on the Aussie off of that news. It's exactly what we were forecasting, exactly what we were expecting. Royal Bank of Australia came out and said exactly what we're expecting them to say, which is that inflation is sticky. We're not planning on changing interest rates. So this reaction that we're seeing this morning, is 125, is just undoing yesterday's price action. There's no bullishness or bearishness in it. Yeah, so it's just a V-shaped recovery or A-shaped recovery, depending on what you're looking at. Yeah, so it's just a reaction and undoing of whatever is was done yesterday. So there's lots of opportunities for ADR reversals on all of these. I will be taking any that fall in line with swaps at 125 ADR. Absolutely no problem getting into these because it's just an undoing of the previous price action, and a lot of the Aussie stuff is very sideways. Yeah, any of these are good opportunities today. Got a nice short on the Aussie New Zealand. When was that taken? Is that the one I've been in for a while? No, it was yesterday. So that was a 125 ADR yesterday. So yeah, just waiting for stuff to play out. RSIs, there's a few as well, but they're obviously Aussies. So 4 hour pound. Oh no, you got pound CAD in there as well. So actually no, it's not Aussies. Tell a lie. It's Euro CAD. Yeah, the Aussies will have undone obviously all the extensions we had yesterday. So Euro CAD is extended on the 4 hour. So there's an opportunity for short there. Nice divergence going in at the moment on that one. Obviously today this is going to move on news, so you know, be aware if you're in it, which I am obviously already in this one. It's going to move on the news. So second entry taken yesterday. First entry was down here somewhere. It's down there actually. Sat in it for a week, pushed up. Second entry's gone in at a supply zone. It's not a very good one though. That's a good one. So potentially that is where we're going to see the next batch of sell action coming in. But we'll cover that in a minute. So that's Euro CAD. We've also got CAD Swiss. First entry taken on that one overnight as a long. So looking for a push back up into this supply zone. Which is also a previous support. That's the difference, which we'll cover. And we've got pound CAD. which is massively extended to the upside. I'm only looking for longs on this because the swaps are too expensive short, but that's really extended. So good potential push back down into the propulsion gap today. So those are the ADRs and RSIs, etc. Morning, I think everybody else. I think those are tomorrow's news. Tuesday. Oh, sorry, yes. What am I on about? Scrap everything I just said. That's tomorrow's news. Tomorrow is CPI and tomorrow is the CAD rate. So we'll do all that tomorrow. So today, that's it for news. There's nothing else coming. So actually, the market will move today. It'll do whatever the hell it likes. We might get a lot of movement in the CAD and the US as they're scaling to positions or scaling out of positions, ready for the news tomorrow. Well spotted evil. I'm a day ahead of myself. Trying to get to Christmas earlier. Morning, voice check. Do you plan on scaling out positions before Christmas holidays? Morning, Sagar. Yeah. I do, yeah. So what I tend to do is it depends actually how the market's reacting. So what I tend to do is watch what's going on. It's very tricky Christmas because you get a lot of dead price action. You get a lot of stuff that just sits around for a couple of weeks and doesn't go anywhere. If I see that starting next week, I tend to just shut the EAs off. Anything that is obviously running, the EA will continue to manage. But anything that isn't got any trading on, I will just shut the EA down on it and not trade it. But sometimes we do get a fair decent move during the Christmas period. It's really, really random. So like last year, I remember last year I took 3 weeks off as I usually do over the Christmas period, and the markets were all over the place. It was really, really good trading. But the year before that, it was absolutely dead. So it's very random. So I kind of tend to judge it by ear. Anything that you get into, the thing with RSI extensions and elastic band theory in general is that anything that you get into that just gets stuck for a week or two, the RSI gets reset. And what is usually happening is an accumulation before the next leg. And the next leg has obviously got a 50-50 shot of either undoing what was just done or continuing. So what you tend to do over flat periods, and that includes Christmas or summer trading or any flat period that you find, is you just get into trades and you hold them for weeks. So there was one we just looked at. There you go. So great example. Euro CAD. Short was taken in here somewhere. Can't see where it is now, but it was taken in there somewhere. And literally, we just went into rotation for a week and a half, and then we had a news event on Friday. So obviously, the RSI just came back to normal, and we're sitting there doing nothing. There's nothing I can do about it. I'm looking for a pullback on that leg. And if it doesn't happen and it continues, that's what position trading is about. Okay, well, that was my price. I'll move my price up there now, and I'll wait for the pullback on this leg. Yeah, you're always going to get a pullback at some point on a leg. You just don't know which leg it's going to be. If you try and guess, you're just going to get stopped out constantly, which is why everybody gets so frustrated with trading. If you position trade it, you're just waiting for, oh, it's not that leg, it's this leg. Yeah. So if we pull back into this accumulation and then carry on that way, I don't care. I'm out. Yeah. So that's what you get a lot of over Christmas. So morning, Sagar. EU and UC. Yeah, so there you go. So another good example there. Look, just sideways. So shorted it. That was an ADR hit short, and then we pushed up, sat around, second entry, sat around, still sitting around. 2 weeks in, and I'm at break even on it. Yeah. So this is the type of trade, Euro US dollar, where if it's Friday, I'm going to go, oh, screw it, I can't be bothered anymore. I'm just going to shut it. Because it's just there's no point in me sitting here if it's going to do this for the entire Christmas period. I'm making money on the swaps, so I'm going to make money on it by just sitting in it anyway. But it's just no point, is there? I don't have to worry about it. If I shut it and don't worry about it, I've got nothing to think about. That's the way I look at it. There's plenty of other weeks in the year. So there you go. Long-winded answer to your question. Just a quickie on the other strategies in forward testing at the moment. The pullback strategy did a 2% loss yesterday. It's got 1% back today, sitting at flat with 5 positions on an equivalent of 2.5 grand ready to bank. So still waiting for it to. The nice thing is it's not losing money much. It's doing pretty well. It's holding its own. But I just don't think the market's quite right for this strategy at the moment. And obviously it's going to get worse, I think, over Christmas. So we'll see what happens. But I think the strategy is just going through a period of stagnation at the moment, unfortunately, which is, part of trading. This is why we do all the back testing, so we can see stagnation. And we know stagnation exists for periods of time when things aren't falling in line with the strategy type. So done 1.1 today, lost 2 yesterday. If we make another 1 or 2% back today, brilliant. We're back up for the week. It's just flip-flopping a little bit. The lazy trader strategy, still banking nicely, up 2.5% this month. We've got 5% of drawdown. Euro CAD and Euro odd. Now, there's a problem with this. This shouldn't be happening. I found a bug in the... it's not a bug in the EA. It's a bug in MetaTrader 4, believe it or not. It's not a bug. It's an anomaly, if you like. It's difficult to explain what it is. So the problem with this strategy is it triggers at 9 o'clock UK time on all pairs. There is a bottleneck in MetaTrader 4, which is called trade context. What it means is when the EA goes to place an order, it goes, I need to place an order, and MetaTrader 4, or rather your broker, comes back and says, sorry, I'm dealing with another pair at the moment. I can't fulfill your request. So what happens is it retries 10 times to place the order, and then it times out. So the problem I've just discovered with this, and the reason I found it was because we had a short trade taken on something, and I was like, but it's pushed up 2 days and it hasn't taken any more trades. And I looked through the logs, and in the logs, you probably can't read it here, but it says here, look, new trade error, trade context is busy, 146, error 146. And what it does is it tries to place the order 10 times and then it just stops, and then it tries again tomorrow. So as you can see here, we missed trades last night on the Aussie CAD, the Aussie US, the New Zealand dollar yen, the pound Swiss, those 4. Yeah, so we missed 4 entries last night. Now, some of these that are in drawdown are in drawdown. If you look at something like, I think it's a CAD Swiss. Yeah, so here, look, right, there's the average price, there's the initial entry. There was no trade taken here, so this day we should have gone long again. It didn't, because we had a trade context error in the fact that it physically couldn't place the trade because the EA or MT4 or the broker was busy trying to place a trade on another pair. So it went, I can't do this one, I'll try again tomorrow. Today it managed to get it on, but the problem is it would have got out here. Now we're in drawdown on this. We shouldn't be. We should have exited. So there's a problem with the functionality. In MetaTrader 5, the functionality is that there's 8 threads available for trading, which means basically that if you have 8 EAs trigger at exactly the same millisecond, it will place all 8 trades. In MetaTrader 4, there's 1. So it goes, okay, I can't place the trade. I'll try again. I still can't. I'll try again. I still can't. I'll try again. And it tries 10 times, but what trouble is, it stupidly, and I don't know why MetaTrader did this, it tries again in the same millisecond. So you probably can't see this down here, But what it says is pound Swiss trade error. I'll try again. And the time it tries is 381 milliseconds before 9. Every single time. It tries 10 times in the same millisecond. Surely a brainy person would go, tell you what, I'll wait 1 millisecond and I'll try again in another millisecond or a second or half a second or something. But it doesn't. So what I've realized is some of this drawdown that we're in here, obviously this wouldn't happen in the backtester. So backtest stands up fine. This is happening because of a glitch in the matrix, if you like, in the way that MetaTrader 4 works. So I've got to try and find a solution for this. So last night I recoded the EA and I put a buffer in of 1 millisecond. That doesn't seem to have worked. So I need to find a way to a solution to get around this. So what I'm planning to do is every 1 minute check if there's a trade taken today. If not, and rules are there, try again. So what it will do is at 9 o'clock, it will try and take the trades. If we get a trade context error, it will try again at 9:01. If there's 5 things that need to try at 9:01, it will get one of them done at least then, and then it will keep going every minute until it's got everything done. So I'm going to say between 9 and 9:10, trigger every minute and just get the trade on. Yeah. So that's it's something that's this is what forward testing is all about. Yeah, back testing's great, everything's fantastic, we can make a fortune. You stick it live, it's a very different situation when you're trading live. There's a lot of different things like spreads, swaps, this type of glitch which you only find when you're actually doing live trading. So I'm going to have to figure out a fix for that, and that's what I think I'm going to do. I've tried to put a delay in, but the delay doesn't seem to trigger properly. So and I think it's because it works on candle close on the hourly. So I will work on that. But if we flick through quickly these trades we've got on, so euro US dollar, we got out nicely today. That's fine. We got a short on there, which is fine. That one we got out of yesterday. But again, look, Aussie US should have triggered a short. Didn't. Yeah, because of the trade context issue. So we should actually be in a short, and we should have actually already TP'd on that short. Euro pound, that's got the sell on. That should have taken a buy. Why is that taking a sell? Oh my God. We've got logic problems here, haven't we? I mean, it's the same logic problems we had in the back tester. So at the end of the day, it's doing exactly what it did in the tester, and it would have done this. But surely if that open, close, should have gone long. But it already had longs on. I need to check the logic on this. I mean, the thing is, I don't really care. It's working at the end of the day, because what we're doing is we're saying get into the market at the end of the day, and if as long as the Asian session is rangy, we're going to make money. That's really what we're saying, isn't it? The direction doesn't really make a lot of difference, to be honest. Euro odd, we got a sell on again, so that's because we've already got sells on. That one traded, took a sell, fine, TP'd. We've still got the longs on. So yeah, that one there didn't trade either. So again, that would have been a lovely little profit. So today's profit is at 0.12. It would have been much more than that. But you can see the sum here where you're just not getting the additional trades on. I'm just trying to find one now. I can't remember which one it was, but yeah, it's this one. Look, so we took a sell here, didn't work out, price pushed up, we should have taken a sell there, wouldn't have worked out, fine. We should have taken a sell there, would have been out yesterday in profit. But because we didn't get that trade and that trade, this one, which is euro odd, is sitting in 0.75% of drawdown. What it should be is it should have banked yesterday a nice little profit. So this isn't correct. So This is, although it seems like a really simple strategy, this is actually quite complex from an execution perspective. But anyway, and I also started forward testing the new EA yesterday. This is the first day it's gone on forward testing. So that is now live, taking trades that support resistance, supply, demand, whatever you want to call it. It's banked 100, banked 0.5% today, sitting in profit on stuff. So this I need to go through today and make sure it's executed correctly. It looks like it's worked absolutely perfectly, to be honest. So yeah. So second entry, it's good. Yeah, so it all looks like it's working fine. Just about to trigger a trade on that. What's the time? In half an hour. So yeah. So there you go. So there's an update on those. Right. Now we'll get on to what we're going to talk about. And if you make an additional instance of MT4, it's per Now this is so good point, VT. I've done a little bit of reading up on this issue yesterday, because it is something that other people have found, and it is only if you try and execute multiple orders at the same time. The problem is, obviously, most EAs and most strategies work on candle close, and what happens is at the end of every 5 minutes, 15 minutes, hour, 4 hour, etc., if you've got an EA running on multiple pairs connected to one broker, they all trigger at candle close, and the candle closes at the same time. So this is an issue that happens a lot. But what doesn't happen with most EAs and most strategies is it doesn't place an order at the same time on all of them. So the problem with the lazy trader strategy is at 9 o'clock every night on every pair, exactly at 9 o'clock, it trades all of them. So it always takes a trade. So it's bombarding your broker with 28 orders at exactly the same time. If you had 3 MT4s running with 10 pairs on each, for example, it would still bombard your broker with 30 orders at the same time. Yeah. And it's your broker basically calling back saying, sorry, we're busy. And it's funny, I read up on this. There's a lot of brokers out there. The brokers can control this. They can control the time it locks. So basically, it's a little bit like if anybody knows about databases. When you query a database and you amend a record, you lock that record out. And when you've finished, you release that record. It's very much like that with a broker. I say, can you take a trade on Euro US dollar? They go, no problem. We'll sit around here for, I don't know, 3 milliseconds, 5 milliseconds, placing this order for you. Oh, what, you got a load of other orders? No, you can't place those, mate, because we're busy. And then when they release that Euro US dollar order, then your other ones can be traded. But the trouble is, they've gone. They've said, no, sorry, you've knocked on the door 10 times, you can't come back in. So that's the issue. So it's slightly MetaTrader's problem in that it can only do one and it retries too quick, but it's your broker's problem in the fact that they control execution time. And execution time is whether they're filling your order direct, whether they are filling your order via a proxy, i.e. somebody else within the brokerage, or they are farming your order out to dark pools and waiting for the order to get filled at dark pool level, or whatever. There's lots of ways they execute orders, but at the end of the day, they do lock your account out because they can only do one thing at a time. Because obviously the trouble is, if you get that order filled, the margin requirement changes. So they've got to do one order at a time, because if you send 10 orders at a time and they fill all 10 orders, you may go well over your margin requirement, get margin called and shut the lot immediately. So they have to execute one at a time. So that's the problem. So I'll come up with a figure. I'll just have to figure out a way around it. There's lots of really complicated coding ways of doing it, and I don't want to overcomplicate it. If you know programming at all, there's always somebody that goes, no, the best way to do it is this. And usually it's the most complex way. Yes, it probably is the best way, but I really haven't got 5 hours to spend on it, mate. I can do it with one line. So yeah, I'll work on that. Then why don't we go full gamble with the lazy strategy? Every day at 9 p.m. UK, we go long and short at the same time on all pairs with 0.2, 0.3 TP, and we take the winner and rinse the repeat the next days. Good question. From what I've seen, And the EA has done this as well. And this is another little weird bug that I went through the code just now. I can't figure this one out either. I will get onto the subject of today in a minute, right? But we got this other weird little bug where some days it takes trade in both directions. Here. Look. Look. We went long, TP, went short, TP. Why? Now, if you look at the actual open price, it's there. And I think it's some kind of little bug to do with spread. But I've looked at the code and I'm not using ask or bid prices. I'm using candle close prices. Candle close was there. Candle open was there. The logic says if close of the last 1 hour candle is below the open price, go long. If it's above, go short. It's below. You shouldn't be going short. So again, there's some little bug somewhere that, and it's not regular either. It's not happening every day. It's very intermittent. So these are the joys of coding and finding needles in haystacks, which is basically what coding is. You do everything and you go, yep, I know how to do all this. And then you go, why? And then you spend your entire life hunting the why. So I'll figure that one out as well. But yeah, there's a good answer. Good, you know. Again, this is something that we could test. I could build another EA to basically say at 9 p.m. go long and go short, and have a target of 0.3 of the 4-hour ADR, ATR, and then deal with what doesn't work. But if you look at Asian sessions, yeah, and this is a good example. Asian session is usually very range bound, isn't it? Yeah, and if you have an Asian session that moves like that, quite often you'll have a UK session that pulls back. So, you know, there's an argument for just getting in, taking what the market gives you and then dealing with the rest, which is what position trading is all about, isn't it? But this is 100% random, isn't it? Doing that. You are literally flipping a coin and hoping that you get a nice rotational period. What the way to develop that type of strategy is to do an analysis on the Asian session for the last X number of years and see what the average range of the Asian session is and target lower than that. So if the average range high and range low of the Asian session from midnight to 8 a.m. is 40 pips, for example, yeah, if we target 30 pips and if it's done that 50% of the time, we know that if we target 30, we're probably going to have a 50% strike rate on the strategy of getting both trades completed. Yeah, win-win. And then we deal with the rest. If the strike rate of 40 pips within the Asian range is 70%, that's our edge. Yeah, that's how you develop edges. It's got to be mathematical and statistical. So, yeah, there is an argument for that. Something we could test. I have a lot on my plate at the moment, so I haven't got time. But if you want to do some analysis on it, it's worth it. And you can do some visual analysis. You know, just whiz through on an hourly chart and just go from there to there is 42. From there to there is 28. From there to there is 40. And do that for 3 months. It won't take too long to do it. And you'll give yourself an average. Anyway, today's topic. Support, resistance, supply, demand. I've got some notes over here. So if I keep looking over to my right, that's why. So obviously the reason I'm going to cover this, somebody has asked, what is the difference between support, resistance and supply and demand? Yeah. So just wanted to note this 35 minutes into the stream. For anybody that wants to watch the replay. I'm just going to put that in the members. 1 second. There we go. 35 minutes into the stream is where we start today's subject, because now I've been waffling for 35 minutes. So, support, resistance, supply and demand. Let me just get rid of those. So the reason this has come up is because obviously the new EA that I'm developing is basically 4 trading zones. Yeah, so the whole purpose of this is we just go, right, I reckon prices go in there, I reckon prices go in there, somewhere around there. I don't know where, no one knows exactly where it's going, but we know that the market spends the vast majority of its time moving from A to B, yeah, and then going somewhere else and coming back to B, and then going back to A, and then going somewhere else and coming back to A, coming back to A-ish, going down to B. That's what it does 80% of the time. 80% of the time, the market stays in balance or rotation, depending what you want to call it, where it's in equilibrium, where banks and institutions have a zone of prices they are happy to conduct business in. Everybody's happy doing business here. Everybody's making money. And then something changes. So this is what we call balance. And then we have a period of what we call imbalance, which is usually a propulsion move. Yeah, which takes us to a new zone where we see if we can trade. And if we can trade happily there, we will do so as long as we can because it's easy to conduct business. And then the market will try and trade somewhere else. If there is no buyers and sellers in equilibrium at this area, it will bounce back to where it was before and get those orders conducted. Then it will try again and it will bounce back, and it will keep doing that until it finds a zone of equilibrium, balance, rotation, whatever you want to call it. So that's basically how the market moves, and this is what creates market structure. So you have an area of balance and imbalance, and then we try and come back and see if we can get further into new price zones. And during all of these bits, you tend to find accumulations. Yeah, so support and resistance are price points. So this is the main difference between support and resistance and supply and demand. Support and resistance is a price level. So that is a resistance. And down here we have a support. Yeah, I'm just picking this at random. It's CAD yen, but it's same on everything. It just happens that this one works out almost perfectly. Look. So let me just move that over there. So there's your area of support, and basically all support is and resistance is a turning point. It is the highest point, the peak formation high, and the lowest point, the peak formation low, in some kind of price movement. Yeah, so that is how you define support and resistance. So that is a resistance, this is a resistance here, yeah, and this is also a resistance. So with resistance and support, it's never, ever exact. And this is one of the major differences between supply zones, demand zones, and support resistance zones. Yeah. So this is a price point that the banks and institutions sold at again and again and again. It's rarely that accurate. It's more like that. And then you'll get a peak which will go there. And then you'll get a peak there. Yeah. But that becomes a zone, a resistance zone. So there's a video I've got on the website if you want to know more about support and resistance and how to draw it properly. There is this video here. Oh my god. There. How to draw support and resistance properly to find turning points. Yeah. So there's that video there which basically explains how to kind of do it, really, if you like, or what I think is the best way to do it. So what I would do with that particular resistance zone there is I would draw a block somewhere around the middle of it and encompass an area. Yeah, so because price, when it comes back, doesn't hit exactly to the price, it misses it sometimes, you draw a zone around it. And usually a zone of around about a quarter of an ADR or something is pretty decent. So if price gets back to this area, somewhere around here, yeah, I'm going to sell it. Because this is where they're selling from, but they're never going to sell from exactly 107,443 next time. They might do. There might be a massive iceberg order there, which there has been for a few times, which will trigger. But it might be 107,510. But equally, it might be 107,577. It might be 107,653. I don't know. I don't know exactly where price is going to turn. Neither do the banks and institutions, because it's basically when they're going to run into a larger order than the order they're placing. That's where it's going to turn from. And that is your resistance level. Yeah. So drawing support and resistance is a very discretionary thing and not an exact science. And obviously there is going to be an area of fluctuation in it. So if we just look at another pair, yeah, so that it's very simple to find it. There's a resistance. That is also a resistance. So it's the high of a wick, basically. Yeah. So it turned from there, then it turned from there. So if I'm going to draw a zone on that, I'm going to stick it around the zone. So go a little bit higher than it, a little bit lower than it, because if it doesn't quite get to that price point before we get overloaded with sells, we want to get in. If it goes beyond it, what your smart money concept traders and your ICT people would call a stop run, it's going to go beyond it. But at the end of the day, it's an area that price is being sold from over and over and over and over again. And then you've got a downside support here, yeah, where price has touched somewhere around that area, yeah, all the way down to there. So if I was going to sell that, I would probably move it down and encompass that low there and encompass the highest low, which is sort of up there. So I might extend that zone sort of up to there, make it a little bit bigger. But again, there is no right or wrong. It's an area. So what we would expect is price to push up and get somewhere around here before they start to sell it. And it's always going to be very, very rough. Okay. So that's support and resistance and how you draw support and resistance zones in. Supply and demand is a different concept, and it's based around propulsion. So the way that banks and institutions move money is they will have areas that they are interested in executing orders at, which is an area of price. So they will be told to sell it somewhere around 57,200. Yeah, doesn't mean they're going to get 57,200. They might get a bit higher, might get a bit lower, but they'll execute batches of orders around that area. Yeah, which is why it's not exact. However, when a move starts, that is what we class as a supply or a demand zone. So let's find a better example. There we go. So when you see have I got? Let me just quickly put this on. Might as well leave support and resistance on as well, actually. Okay. So Barrier Man's back from the gym already. Blimey. Does it make sense when a support resistance zone breaks and is making a pullback to the breakout to implement a stop and reverse mechanism? Yeah. Yeah, definitely. So with support and resistance and supply and demand trading, a lot of people will be always in. So you will say, I'm going to get to there. When it gets to there, I'm going to short it. And when I short it, I'm going to look down and find out where I think it's going. And I will wait until it gets there. And if it gets there, I will get out of my short and then I will go long. Because the reason you are getting out of your short is because you think it's going to stop there. So you go long. Yeah, it's an always in type strategy. So if it breaks through a resistance level, you could, if you want to, stop out and then flip the other direction. That's what a lot of banks and institutions will do. You'll hear me say it all the time. If you hit a support level like this and then it pops, the guys that were buying will flip short. They will take a small loss and then they will look for the next support zone below to make their money on. So you could do that, or you could turn it into a position trade. So if you said, when we get back here, I'm going to sell it, and it doesn't, you would go, okay, I will sell it again at the next one, average in, and then get out when we come back and retest this, because this was previous resistance. It now will turn into support. Unlimited ways you can trade it. So you can either be always in or you can be stop and reverse. The problem with stop and reverse style trading is you can get stopped out on it So let's say, for example, price came down here and we took a long on that candle. Yeah. Our zone was around there. Let's draw a proper one on. So we would have, I can't draw a buy because it will just immediately take an order when the candle closes, I think. But let's say we drew it in like that. Yeah. And then as price pushed into it, we extended the zone down. Then we took a long here. If we are going to go long there, our stop and reverse point has to be there. So what we would do is we would take a loss there and then we would flip short, and our stop loss on our short order would be if we broke back above there. The problem is, if you're unlucky enough to pick a support and resistance that turns into an accumulation, you go stop out, 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 stop out. And if it lasts for 2 weeks, you will get stopped out for 2 weeks. Yeah. So it's got pluses and it's also got massive minuses. So if you got stopped out 5 times there, you need a 5R on the break to actually get your money back. I'd rather position trade it personally. Get in once and let the price do its thing. Let it breathe and then let it decide where it's going. If it's going to go there, I'll add. If it's going to go there, I'll get out. Yeah, it's 50-50, isn't it? This is stop out, stop out, stop out. But sometimes it works, sometimes it won't. Yeah, so different style of trading. So supply and demand zones are based on the propulsion move that starts the move, basically. So we were talking about price accumulating and being in balance. At some point, there will either be a large order placed by a bank or institution that there are not enough buyers to fill and it will go pop, or there's a news event that will change the bias of the market that is being traded and it will make a massive spike. Yeah. And the supply zone and demand zone is basically the accumulation before that happens. So we have the propulsion gap indicator. The propulsion gap indicator indicates a large bank order. So we can tell using the propulsion gap indicator where the supply and demand zones are, because to have a supply and demand zone, it has to be before a propulsion move. So that is a propulsion move. So the supply, in this case, area of that propulsion move is this accumulation before it. Zoom in so we can see better. Yeah. So this is the propulsion move that started that leg. Yeah. This is the accumulation before that propulsion move. So this is the banks and institutions accumulating the position ready to execute it. So supply is above, demand is below. Don't know why they named it like that. It's bears and bulls, basically. But that's basically how you tell the difference. So instead of being a high or a low, that is a support there. Yeah. And that is a supply. So it's where the move started from. And it's a little discretionary as to how you draw it. So if you'll see there's some indicators out there that draw in support and resistance and supply and demand rather. And what a lot of them will do is they will just pick basically before the move starts, and that would be where I would class the move as starting. It did also start kind of there though, didn't it? But what they will do is they will pick the candle before the move starts, which would either be that one there or it would be that one there, and they will call that the supply zone. Yeah. For me personally, it's the accumulation period before the move. Yeah. And you can or can't involve wicks in it, whatever you want to do. But for me, that candle there and all of these inside bars and tiny little candles are kind of generating this accumulation towards the end of that New York session before Asia moved the market. So that's where I would personally draw that supply zone in. But you ask 10 different people to draw a supply zone in manually, you'll get 10 different answers. Some people will be using that candle there because this is the propulsion candle. Some people will use that one and say, well, this 3 bar propulsion move, that's the candle before the propulsion move. Yeah, so it's entirely up to you how you draw it, and it's very discretionary, which is why I spent a long time over the last week doing different algorithms to draw in supply and demand, support and resistance levels around weekly highs, monthly highs, daily highs, propulsion moves. And do you know what? Every time I change one line of code, it draws in a different place, and none of them are going to be right and none of them are going to be wrong. But support and resistance is a lot more discretionary in the size of the area you draw around it. Supply and demand is a lot easier to determine than support and resistance because it's the accumulation before, and the size of the accumulation is either the high or the low or the body you pick. Yeah, so that's how you draw that in. So the theory and the logic is, when you have a supply zone, or in this case down here a demand zone, let me just draw these two in properly so we can see them on the chart, because there's two nice ones here which are absolutely perfect. Yeah, now this one here again, so there's that low there, there's that high there, but there's also this low here. So do you class that as the accumulation, or do you class that as the accumulation, or would you say it's these 3 or 4 candles here? This is where the discretion comes in. But what it is it's picking a low and a high of accumulation before a propulsion move. So to trade supply and demand is more accurate in size, and what the theory is when we get back to this zone, what happened here was banks and institutions were accumulating price. They all wanted to get on to that move. However, not all orders could be executed because there's always what's called an imbalance left in the market, or what the if you trade stocks or futures, you'll hear it called unfinished business. There's a term called unfinished business, which is basically orders that were not completed. We often use propulsion gaps for unfinished business. So in this particular case, we had an accumulation break where the market moved very sharply to the downside. This propulsion move was banks and institutions that got onto the order, and as it came back, they added more size to defend their initial position. Yeah. And then everybody that tried to get back here to get their short order on gave up. Yeah, so that's the underlying mechanics behind that move. So when you have this move starting, one of two things will happen. Either this propulsion move will prop price up, as it is in this case at the moment, or it won't be able to. And what will happen is when price gets back to the demand zone, in this case, this will react as the support. Yeah, so this is where the move started, the large execution of orders happened, so the accumulation break happened. The guys that missed this will place their limit orders at that zone to automatically get them into the continuation of the move, because what these guys who missed the order are expecting to happen is, if the price gets back here, the guys that got on the order are going to add more size. They will try and do it beforehand, which is why propulsion gaps work. Yeah, because they don't want price to get back to here. Think about it as a trader. If you've gone short here, yeah, that's your break even. You don't want to go to break even. You want to stay in profit. So you will do everything under your power to keep that position in profit. Or you have to make a difficult decision. Do I exit the position and go, we didn't make that one? Or do I stop and reverse and go the other way with the power that's coming back at me? So you've got a decision to make there. Whereas here, if you can keep price in the green, you don't have to make any decisions. You just go with it, and you hope the other banks and institutions come behind you and help it on its way. So that's the difference between the two. Yeah. So if you are a support and resistance trader, you would be placing an order up here. Yeah. Expecting this supply zone to be invalidated, and then the sellers that started to move before they added there to add back in again. Yeah. If you are a supply demand trader, you are assuming that the guys that started the move are going to maintain that position and defend that line. If you are a little bit more risky, you will try to trade the addition into the propulsion move. And one of those three things is going to happen the vast majority of the time. So you don't know which it's going to be. So in a move like this, for example, you've got a choice, haven't you? On a higher time frame or a zoomed out view, you could go, if we get into this area, either the propulsion guys are going to win, the supply guys are going to win, or the origin of the move is going to double top. Yeah. So as we are down here at the moment, if we get anywhere in here, I'll short it. Yeah. And a backup would be, that didn't work out. So let's have a look at this area up here, which is a previous support that broke, and we would expect that to turn into resistance. Yeah. So that's basically the difference between the two. They're subtle, but the important thing to understand is the logic behind them, why they exist. Yeah. So the supply and demand, the problem with people in this kind of education space, if you like, in trading, and traders in general, is they want a system and a strategy, but they don't want to understand the mechanics behind why the system or the strategy works. That is the mechanics behind it. Accumulation of orders, starting a move into profit, adding into the move into profit. If the add doesn't work, the additional orders left over will trigger to make the supply work. If the supply doesn't work, the orders that started the move will work. Yeah. So those are the three reasons it happens. Banks and institutions have a pot of cash they can use to execute this order. So they start a short, they accumulate more positions, they start a second leg short, they wait for price to pull back so they can get a better price, and then they add more in to defend the positions that they've started. That will only happen if there are not banks and institutions with more money and capital than they have to drive the price in one direction. It's just literally monetary movement. If you've got 100 million here and you've got 50 million starting that move, this will not work. Yeah. But you can identify them very, very easily when you understand the mechanics of what's going on, because the key to it all, and this is why I have this indicator, is the propulsion gap. If we're looking for when banks are moving money, this is where it happens. Yeah. So we can then decide, I want to be a supply trader, or I want to be a propulsion gap trader, or not. I want to wait until it comes back for a double top. But if that order is going to work or that order is going to work, you know, price is going down. So the thing to do is to look for where it's going to head and then try and get in on the next area, which is the propulsion gap. Yeah. But you also had multiples. So there's an accumulation break there. There's an accumulation break there. So these ones back here are demand zones. Yeah. So where you have a large order, these aren't particularly good, look, but that, I'm just going to need to grab my box, move it over. So this one here, yeah, and this is where it becomes a little discretionary. This one here could be drawn like that. Yeah, so that low, that high is part of that accumulation, which is basically kind of London, New York session, or London, New York session really. And then in Asia, they broke it. Yeah. So you would be looking to buy on that retest there. That's the propulsion move there. And it got down and they added into it before it even reached that. So again, this is all very, you know, it's not always going to hit these zones. These zones are there to be traded from, but there's no guarantee they're going to work. The next one up from there. Can I grab my box? No. Need to make it smaller. So the next one we saw there, where was it? So that was that accumulation break there. we broke down from that zone there. Yeah, so again, some people will draw it on that one candle before, whereas I prefer to look at the kind of, it's a kind of a low to a high move. So that would be the accumulation there. That's the trade that I would take on that one. Yeah, out of that propulsion move. But the propulsion gap is here as well. And, you know, they added in there, and then they failed. So there was obviously way too much buying pressure to push them back. But this is the unfinished business executing at that point, saying, no, we're short from here, we want to add more in. But then you had the support zone, which held, and they bought that back up. It's always a battle. All you're doing when you're drawing anything on your chart, which is horizontal, in zones, whether it be supply, demand, support, resistance, propulsion gaps, whatever, they are literally just battle lines. Yeah, this is a large bank order going into the market. This is a large bank order going into the market. This is the bulls, this is the bears. If the bears are going to win, this is going to hold. If the bulls are going to win, this is going to hold. That is all that happens. And this is how we know where price is going, because if you know how the market works, you know where it's going. It will return to that area, or the propulsion or the accumulation before that broke. That is your supplies, that is your resistance. Yeah, and on the way it's going to make propulsion gaps, which if the market is strong enough will act as upside resistance, dynamic support resistance. Yeah, so that's basically how it works, and how to define the two. There is no better or worse, in my opinion. I have tried in the past supply demand zone trading. I've built EAs to test it. I've used indicators out there that draw in automatically supply and demand zones. There's three main ones that I found which were great. They all, guess what, drew it differently. So which one's the one that works? Which one was the one drawing the true supply and demand zones? Down to the person that coded the EA at the end of the day, or the indicator, because it's not an exact science. It's discretionary. Price is not accurate. Price will move around areas. So you can draw it how you like, but that is the theory. So the difference between the two, I find, is that supply and, well, my experience, supply and demand I found very challenging to trade. And this works on all time frames. Yeah. So the bigger the time frame you go, yeah, that would be where I would put that demand zone in. And look what's happening right now. Yeah, we've got a buyout of demand. Yeah, you would have had a buyout of this. There's no big propulsion. You need to have a propulsion gap. If there is no propulsion gap, there is, in my opinion, no demand zone or no supply zone. You've got to have an order big enough that the market cannot get back to that area it bought from, or sold from in this case, causing a propulsion. So don't forget, a propulsion gap is a push down, and you've got a low before it, and the high of the next candle creates an area of clear air, space, where we've not traded. So we've pushed through an area, we couldn't trade back into that zone. That area before comes the demand. Yeah, you have to have a propulsion gap. So, but again, some of these indicators didn't require that. And for me, they just failed all the time. So it's very, very discretionary to trade. But with the new EA that I'm building to trade this, obviously, you need to understand the difference, because what I will do is I'm going to go short if we get here. Someone else will go, no, you shouldn't be shorting that. You should be shorting that. I mean, you wouldn't do that in this case because it's not a, or rather, here we go. There's a good example. Look, I would draw a zone up there, because that is a monthly high. So that is, as far as I'm concerned, the 2-month resistance, or last month's resistance. Someone else will go, well, no, I wouldn't draw that. I would do that. Yeah. And basically, if price comes back up, and it didn't in this case because the market was too strong, if price comes back up into there and bounces there, they will go, see, demand is better. Now, if I draw my support resistance zone like that, I will go, see, my resistance zone was just as good as your supply zone. Yeah, but if I draw my resistance zone like that, the guy that is using supply and demand gets the trade on and I don't. Does it make it better or worse? In that case, it makes it better. But if it had gone into that zone, done that, and then blown through it, and then done that, I would say that my zone's better. If it had done that and flown out the top, we'd both be going, neither of these work. Random, isn't it? Yeah, because when you get back to any point in price, if there are more orders short than there are long, it will go down. And you do not know, whenever you get back to a propulsion or a supply demand zone or a support and resistance area, how much volume of orders there is in the market. However, we know that if there is enough support, resistance, supply, demand, volume at that area, we will bounce at it. Yeah, so it just increases our odds. If you take a trade, there's the low and the high of that month. If you take a trade in the middle here, your odds are 100% a 50-50 on it going up and down. There is absolutely no reason for you to say, I think this is going up because, or I think this is going down because. When you get to a previous area of resistance, you have a much higher probability of saying, if the banks are still short, it will bounce. And that's the thing that gives you the edge. If the banks are still short, it will. But you don't know if the banks are still short. And this is where people using stop losses get killed all the time, because you get back to this area and you go, it's working, it stopped me out, it goes down. Well, you are absolutely spot on. This is where the banks are selling it from. You just put an order in the market to say, if I'm 10 pips out from my entry, take my money away. That's where everybody goes wrong. But if you got in here as a short and it didn't work out, you had another short there, you move your price to the mid zone, which is the demand zone in this case. And if it goes from the demand zone or that, you're right. You've got 3 areas of price, including a propulsion gap there, 4, that have the possibility of having a whacking great portion of sell orders in that you can utilize to make your move work for you. If you take a trade from the middle of this range, absolutely nothing to help you. There's no banks and institutions massively long or massively short from a particular price point or zone. Yeah. So it doesn't matter which you use, but it's important to distinguish the two, because I know I'm going to get asked with this particular EA, why are you putting it there? Because that is what I would class as that supply zone. But why not put it there? All right, we'll do that. Ta-da! And now you're covering the supply zone and the resistance, and you're giving them a chance to do your ICT stop run. It's just an area they sold it from. Somewhere up there, including this propulsion gap. If you want to be super, super safe, let's take the propulsion gap into account as well. It still didn't bloody work, did it? We didn't get back there. Why? Because there's just too many sellers in the market. This propulsion gap is where they sold from. We didn't know that then. Yeah. So there you go. That's support, resistance, supply, demand. Let me just see if there's anything I've missed out. I think I've actually managed to go through all my notes in my head without needing to refer to them. Yeah, no, there's 2 other bits I've forgotten. I haven't forgotten, they're just additional bits. Kind of more advanced supply demand, if you like, is the second leg. If you, this is a little bit more tricky, and you've got to find, there's a good one, there's a great one. This is the intervention from Japan. Yeah, but so this is an extreme case, but when you get that supply kicking off, yeah, we start a massive leg down. What you're going to find on the way from A to B is multiple pauses or accumulations. So we pushed down hard and we accumulated. We pushed down hard, we accumulated. We pushed down hard, we accumulated. Hard, accumulated. Hard, finish the move. So there's 1, 2, 3, 4 legs in that downward movement. No market structure. Yeah. And this is a difference between supply and demand and market structure trading. Market structure trading relies on profit takes on the initial leg and then additions of orders. Supply and demand trading can be just accumulations, which then continue the break. Yeah. So there's no pullback, not even a flag. These are just accumulations. You won't see these as often, but all these are extra supply zones being put in. So in this particular case, this is a good example, actually, Aussie New Zealand, because it's an extreme case and it explains the point a lot better. There is an accumulation. So that high there and that low there is accumulation. Now, you could be super accurate and go, no, it's not, it's that. And you're right. But you're also right to do that because it collapsed from that point. And then we move down after that collapse and it starts to pull back. So we go, okay, we're pulling back from this area and we pull back into that high there. Yeah. So that is an accumulation zone, or rather a supply zone. So we're supplying more orders, price moves down. Yeah. It's too big though for me to trade. So this is the area where you get your discretion out and go, right, well, I need it to be no more than, I would say, a quarter of an ADR, really. What's 1162? 1426. Well, this is because it's the intervention. Obviously, there was massive price expansion, wasn't there? So the ADRs are going to be way different here than they are now. But yeah, roughly a quarter of an ADR. And obviously the ADR over this period, because we're looking at a 4-hour chart, this is 2 weeks. So your ADR 10 is that, isn't it? That's where the measurement's coming from. And then we push down again. We stopped. We had another little accumulation. Little bit of a weird one there. But again, it was. And now you could say that was the accumulation, because this is the propulsion move that started. However, there's no propulsion gap. And again, it's not exact science. This one didn't have a propulsion gap, but I would class that as a supply area. And look what happened. Yeah, we got back to it and we struggled to get through it because all the limit orders that missed that are triggering and firing back. However, that's a wedge break to the upside, basically. And then we just sat around for ages. There's areas where you would draw it in and you get a propulsion move and it just doesn't work. It just goes sideways. Yeah. So again, this one you could say, well, it's not working out. I'm just going to shut it. It would have worked out a little bit. If you're using risk reward, you might have got 1.5 hours out of it, but it took you 3 weeks to get there, didn't it? So they're not going to be great. The best ones you're going to find are the ones where you start massive. Big, strong move. So the propulsion move, you know, this candle 2, 3, 4 times bigger than the accumulation before it, that's a really good zone. And they need to be fresh. So this one here, I've got to go back a fair way. Yeah, this is a 4-hour chart. And again, I would do this on the hourly, really. Anything that's a week or more old is old. It's gone. It's done. Now, sometimes they will work out, but a lot of the times they won't when they're that old. So I like to look at these more of an hourly time frame. So when you get to the 4-hour time frame, you'll find that they don't work as well because the move's all over. If you think about it, if you shorted this, yeah, would you still be short 4 weeks later after it's moved down that much? You're out. Yeah, that's gone. But on an hourly time frame, yeah, something that is younger, like that one. So this happened within a week. Will hold up. Yeah. So the resistance traders that traded out of that propulsion gap, yeah, if I had my short there, I didn't get it on. But as a supply or demand trader, I got it perfect. And the reason that happened is because that is the propulsion order that the guys that were accumulating here missed. And now we've got another chance to get that trade on that we wanted, because this move is caused by a fundamental shift. Usually there's something happens that causes this. It needs to have gone away from that zone and then come back to that zone. Anything older than a week or two, it's probably not going to work. Even a week. Yeah. I mean, you want to come back as early as you can to them, really. But you'll find, and this is the thing I found annoying about them, a lot of the times you won't get back to them. Yeah, so what you do is you mark up your charts and you go, oh, this is great. Or you've got this indicator that draws all this stuff out automatically for you, but it never gets there because there's a massive propulsion move going in the opposite direction. So yeah, to get back there, it's going to take a hell of a lot of buyers or the guys that started the propulsion move to be very, very wrong. Yeah, so, but it's all part of the same thing. It's order management by banks. And if you get confluence of the three together, brilliant. You've got way more chance of that zone changing, working. And you've got obviously two ways to do it. So if you want to use stops, you would draw the zone on and encompass stuff around it. You know, always look around your chart. So there's an obvious weekly resistance, which was a double top out of a propulsion gap, which has been added to 3 times. If it gets back there, it's a good short. Yeah, but that's where the move started from. So if you want to be super safe with your trades, encompass the propulsion gap, the double top, and where the move started from, and stick a stop loss just above there, because if it gets beyond that supply zone, this is dead. It's done. It's gone. Yeah, there's no one left in here selling, and the reason is probably because they're all out and they've all flipped long at the old area that they bought from last time. So from a stop loss perspective, what you're looking for is price to come into this area and reject it, and it's either going to reject it there, somewhere around there. Don't forget, this is also, look, and again, this is where it gets complicated. This is a stacked zone. I can't draw this because I can only draw one box, but this is a stacked zone, look. So this propulsion move here started here, but you've also got this supply there that has not been tested, and this is another important thing which is on my list to get to in a second. But if it's been tested, i.e. we've gone through it, it's done. So they're the same as support propulsion gaps. If it's blown through it, it didn't hold. Yeah, doesn't mean it won't work, because usually they're a pullback on a fib. So there's a reason that went, it's because of fib. That's a 71.8 fib pullback. There's a million reasons you can get in with the same logic, isn't there? But that is a supply there. That is a supply there. This is a propulsion retest. That is a resistance double top. This whole area here is good. That one worked. Yeah, you can adjust it. So again, this is one of the beauties of this indicator. If I like that zone here, which started that move, so if I draw it in there, for example, and say that's the propulsion move I want to get into, we didn't get back to it, we didn't get back to it, we didn't get back to it, price pushed down, move. There we go. So that's our new supply. Yeah, we didn't get back to it. We accumulated and broke down from there. Okay, move down. Yeah. Now in this case, that failed, but that worked. So this was the original supply zone. This was the resistance, previous support, term resistance, bounce. So that is where you should have been drawing it, at that resistance. But you didn't know that. At the hard right edge right now, there's 2 ways you can do this. You can either go, I am going here in that supply zone or demand zone, or I'm going on that support, or I'm going on that support and demand zone. To the upside, this is invalid. So you can say I'm going to go with that daily high resistance. But what I'm going to do is incorporate this. So if price pushes into this area and immediately rejects it, opens inside, closes below, wicks into, closes below, you can get in. Or you could say, I want to wait until price goes bearish inside that area. Yeah, again, which of those is right? One of them is. Which one you're never going to know until it's happened. It could be that none of them are right and it just blows through it. And if it blows through it, it's going to extend the zone up to where? The next area of supply, which is there. So if we get a news event and price goes like this and then screams up into that area like that, this is where it will probably meet some resistance. The area they sold from there. If there's buyers left, that's where it's going to work. You know, so this is why the EA has these expanding zones. So you can set in the EA to either have it expand or not expand. So extend zones if price exceeds them. So what would happen is if this zone here, price got up to here and then went like that with a bull candle, if you don't have it expanding, it removes it and goes failed. If you have it as expanding or extending, what it will do is when that candle closes that pushed up through here, it will then go, okay, so now we're going to extend it to there. And if it then goes bull again, we'll go, okay, we'll extend it up to there. And then we get a bear candle and we enter. And we get a much better price than we originally thought because it's moved up to that resistance, that propulsion, or that supply. Yeah. We don't know which it's going to be. You never will. If we knew that, we'd be millionaires. We're not. So there we go. That's how it works. Any questions on that? So are propulsion gaps not supply demand? No. No. So the propulsion gaps are large orders, propulsion moves. The reason they're called, well, again, you know, everybody's got a different word for stuff. The logic, the reasoning behind me being taught that these are called propulsion gaps or propulsion candles. This is the gap formed by this is a propulsion candle. Yeah, a big candle. That is a propulsion candle. The reason it's called propulsion is because we had a accumulation and then there was a big strong move. It was propelled. Price was propelled strongly in one direction. If you are a Wyckoff or a Elliott wave student, you will call this an impulse move. Yeah, and an impulse move is another way of saying the banks and institutions decided to. They had an impulse to move price. They propelled it. Yeah. If you are an ICT student, you'll call this a fair value gap. Makes no sense. There's no logic or reasoning behind the words fair value. It's your opinion that this is an area of fair value. It's just nonsense. He needed to sell a course and he couldn't use the terminology. I don't know what it was, but anyway, same thing. Yeah. But this is the order having happened. This is where the supply for the order was created. It's the accumulation before the event. Yeah. So you need to have price sitting around. And I would say if you haven't got an area of accumulation of 3 or 4 candles, at least before that move happens, it isn't. So this is a V-shaped recovery. This here is not a demand zone. Yeah. Because there is no accumulation of price. For banks and institutions to move price, they need to accumulate a position that they can then execute. That is done by moving up and down, by buying and selling over and over again until you have an imbalance in one direction, i.e. if the market goes that way, I make 1.5 million. If the market goes that way, I lose 0.8. I need it to go that way. I will propel it this way. If it doesn't, I will go into drawdown and then I will wait for an area to accumulate a new order to push it back, because the guys that pushed me this way will have run out of their orders. I'll take all of the orders they give me and so I can push it back the other way. It's just supply and demand is the reason people call it supply and demand trading is because that is what drives the markets. Supply and demand of orders. Yeah, commodities are driven by supply and demand. If there's an oil pipeline blows up in UAE, yeah, the supply of oil reduces. The demand stays the same. So if I have oil, I can charge more for it. Oil price goes up. When there's a war, all of the machines we use need oil. The supply is the same, but the demand increases. Price goes up. If the demand increases and the supply drops, we go parabolic. Yeah, look at oil when the Ukraine war kicked off. Didn't stop for weeks because there was a massive demand for jets, tanks, everything to do with oil. And it was in an area where the oil pipelines went through, which were no longer pumping. So demand went up through the roof, supply dropped. Parabolic. Yeah, it's exactly the same thing here. We're accumulating and driving price in one direction. This is where the supply of orders created the parabolic impulse move, propulsion move. Yeah. And then they add into the void created additional orders. Yeah, because they have made the move and they are making the move stick. They will only make the move stick if there's enough people driving price back to that level that they can accumulate all of their orders and absorb all of their orders. It's called absorption. Yeah. If in futures trading, you'll hear this referred to as an iceberg order. So this, this is why trading is so confusing. There are so many names for the same thing because people try and explain things with different concepts. Yeah. So this is called an iceberg zone in futures. And there is an iceberg order sitting there. And all an iceberg order is a bloody great order. And it doesn't matter if you've got a whacking great ship and you drive into it, the iceberg's not breaking. Yeah. Someone is sitting here with 100 million shorts. If you come at it with 10 million, you ain't getting past. Come at it with 50 million, you're not getting past. You come at it with 75 million, you're not getting past. This guy's got 100 million. All right, well, I'm not going to get through. So I will have to close out my order in that direction at whatever price I get, maybe positive, maybe negative, and I'll go with the 100 million order, because if we're not getting through it, we're going to go somewhere else, down. So this is where you get the flip and reverse in banks. This is why I say they always into the market. The banks and institutions always have a position on, because you've got so many transactions going through. You've always got a net positive or net negative gain on a position. So you have a bias always. You have X number of contracts long, X number of contracts short. If you execute 100 contracts long and then you execute 75 contracts short, you are net long 25 contracts. So you want price to go up. If you have the ability to, you will add to that to make price go up. That's how they work. Yeah, this is why banks never lose money, because they have an almost unlimited fund, because we are all putting money into our banks. We have savings, businesses are transacting. Every penny that goes into the bank can use to do whatever it wants to. Pension funds, hedge funds, there's also all sorts of transactions going on. But at the end of the day, they leave footprints, and that is a footprint based off of a supply of orders executed in one direction and added to. Yeah, so different concept. But what this movement does, this bank ordering movement does, is it creates points where we got exhausted. And as that happens, the bias of the banks and institutions at that price point will change to the opposite direction. So when we get back there, they have seen this change. They will add to that change, which is why double tops form. We sold from that area 3 times. Not coincidence. But there's multiple reasons for that happening, which is why these work sometimes, but sometimes they won't, because the flow of orders or a fundamental, a news event or something shifts where it's just not relevant to do that anymore. This order that was placed here held, but not very well. But this order that was placed here and this order that was placed here got blown through because there was just no need for them to keep short. It may be that they were exhausted from being on multiple short legs, and there's just not any sellers left in the market. Not enough buyers to fill the sell orders, yeah, which is why we get the pullbacks. Yeah, there's a million reasons, but at the end of the day, this is what you have to understand with trading is when you get back to whatever you are getting back to, the balance of orders at that particular time is what designates whether that holds or that doesn't. And this is why people get frustrated. I've tried supply demand. Sometimes it works, sometimes it doesn't. I've tried support resistance. Sometimes it works, sometimes it doesn't. I've tried propulsion. Sometimes it does, sometimes it doesn't. I've tried RSI. Yeah, because it's always 50-50. There is always a 50-50 shot. It will work or it won't. There is a binary market you are trading. It goes up and it goes down. It will move up and down from areas. If the area you've selected is correct, it will work. If it's wrong, it won't. How you manage what happens at that time is how you make money. If you get in and you use a stop and it works, you have to get out with more than your stop, and you have to be right more than 50% of the time. If you get in at a point and it doesn't work, and you decide to get in again later with a small lot size and you change your order price, that will work. But it's got nothing to do with that or that. It's management of order after execution that is where you make the money. So this is a way of getting in, but it's not a way of making money. It's a way of identifying a high probability area that market may move from. You've got to wrap risk around that to make money out of it. But you need to understand the differences between them and the mechanics of why they work. So you pick the one that you like, or all of them, you know. And the best case scenario, you know, this right here now is an amazing area. Yeah, so that whole area there is great, isn't it? In fact, that I mean, obviously we know this has reacted, but we've got a propulsion gap with confirmed sellers in it. We've got a supply area with propulsion and confirmed sellers in it. We've come back, we've tested, we know the sellers are still there. So if we come back to that area again, that's a good sell point, because we've got so much selling going on in this area. However, if we get back here, is it going to be everybody's now flipped long and we just pop straight through it? Maybe. So we'll short it there. And if that happens, we'll short it here, because that's probably far enough away, more than half an ADR, 3/4 of an ADR, and we'll change our price to the middle of that area. But what might happen is it might get there, blow through that, not get to that point, accumulate for a bit, drop, push, drop, and then come down, in which case that trade worked. But we don't use stop losses, so we don't get stopped out. We let the market decide whether it's going long or short. Our job is to identify where it's going. Yeah, so if we get back here and it bounces, what's it going to do? It's going to go up there, or it's going to go down there. That's our trade. It's one of those things with 100% accuracy is going to happen, because it cannot stay in between that point and that point for the rest of the year, for the rest of next year. It has to go above or below one of those points. So what we are doing is saying, if it goes down there, I'm going to make money. If it goes up there, I'm going to need to change my price. But it's all about picking logical areas of support, resistance, supply, demand, propulsion, bank orders. It's about knowing where the bank orders are likely to be. We're hunting where they are. We don't know where they are, but there's a likelihood they're there, but they could be there. They might be there. God, I sound like Ant and Dec on The Jungle, don't I? It could be you. It could be you. It's not you. But that's literally what it is, isn't it? If it's going up, it's going there, there, or there. And it will react at one of those. We just need a reaction big enough to get below the price we've just entered our average at to be able to get out of the trade and make money. That's the job. Yeah. So identifying the zones is key to that. But for simplicity's sake, we can use RSI and ADR for elastic band theory, because when we get an extended move on RSI or ADR, what has happened? When the RSI is extended, let's just find one. When the RSI is extended, what have we had? A supply zone create a propulsion move. Yeah. So by the time this has done this, we know that there's a high probability of it coming back to retest that. So we can do the inverse of supply and demand. Supply, demand, and support and resistance is about trying to find the bounce point. Yeah. Elastic band theory is forget the bounce point. What we're trying to do is getting on them coming back to a bounce point or from a bounce point. Yeah. So it's all the same thing. What we're doing as traders is trading movement in price. So you can either identify where it's gone where it started and try and get in around that area, or you can wait for them to go back to that area. Both strategies do the same thing. But again, this isn't right a lot of the time. That isn't right a lot of the time. Was that there? But it wasn't. It's not right all the time. This one here worked there and failed miserably there. Yeah. So buy it. Whoops, didn't work out. So we go and look at where's the next place we should buy it from. Haven't got one on this one. You've got to go out a long way to find some previous support because we're out in all-time lows. But yeah, that's all it's about, isn't it? It's about identifying areas. But if you try and get in with 2% risk and put your stop above each support and resistance, supply and demand, whatever zone you're drawing in, line, whatever it may be, indicator, all that's going to happen is you're just going to hemorrhage a lot of your money because you won't be right a lot of the time. But if you can increase the probabilities of being right more often, you are going to take less drawdown. So it's all about reducing pain. Pain is always going to be there. We're never going to get it right. Stuff's changing. Yeah. Trump either did or didn't get in. You had either a long or a short bias, and it was down to who you thought was going to win. If the other guy got in, you lost, or you went into drawdown. It's about trying to minimize that. And that's hopefully what will help you. So this is an alternative to normal position trading methodology, but you can use this as stop loss trading as well. Yeah. So, but you will find it will fail a lot of the time. There's a great little zone there, look. But that didn't have a propulsion gap. See, a lot of people will draw that in as support and resistance, or rather supply in this case, and it worked very, very well. But it's a previous propulsion gap. But some people will call that the supply zone retest. I call that a propulsion gap retest because the supply zone was really there for me, but that's a second supply zone. So yeah, that's right as well, isn't it? It's market structure too. It's also a double top. You know, it's all the same stuff, isn't it? At the end of the day, this is why I say if you go and buy 10 courses, buy one on supply and resistance, support and resistance, buy one on supply and demand, buy one on ICT fair value gaps, buy one on Wyckoff theory, buy one on Elliott wave theory, buy one on Fibonacci. You're going to get the same education. They're just going to give you 5 different entry points, but none of them are going to have any more than a 50-50 shot of working. They will increase your probabilities of that particular pattern that you've been taught playing out. But I will see many other patterns. I see all the patterns. There's fib pullbacks in here. 71.8 and 50% fib pullbacks in there, as well as propulsion gap bounces, supply bounces, and weekly high bounces, and double tops, and 3-bar reversals. It's all the same stuff. It's just price going up and down. Yeah, just need to wrap risk around it. There we go. That was a long one, wasn't it? But mainly because I waffled for half an hour. So, but that was about an hour session. So that's about right, isn't it? Any questions? And is it clear? So the purpose of it was to you know, distinguish the difference between that and that, basically. So that's the takeaway. There's probably quite a few takeaways in there. Let me just check. No, that's it. Yeah, that's all I wanted to cover on it. Is anybody still here? Anybody still awake? This is where my chat doesn't move and I sit here awkwardly for the next half an hour. Evil's here. With support resistance, supply demand, it feels like the spacing between positions could be quite bigger compared to regular RSI and ADR. Yeah. Should the risk be adapted? Yeah. The difference it's not necessarily that much different. What you will find is if you get in, so let me open up the VPS because this has taken some trades. on the support resistance side of things. So I've got short here off of this zone. Yeah, so that is a 2-bar accumulation before a propulsion move. So it's not really a support. And, you know, this is why I draw it pretty rough. I'm very rough with everything I do in trading, because you get battered after a period of time in trying everything and trying to be exact. The market is not exact. The market is completely and utterly random. There's no 100% logic. This happens all the time. So you suddenly become impenetrable to, I've got to put it here. I could put it there. Yeah, I could put it up here. I don't know. Somewhere around there, it will probably bounce. But if it doesn't, it was probably going to bounce somewhere around here, because that's what it did last time. But I'm just putting a box here. If it gets here and puts in a hammer, a shooting star, a hammer even, I'll take it. But that would be more like that holding, wouldn't it? But it could be also that we didn't quite get to that point and they bought it a little bit higher. I don't know. But when I get in, I'm now going to, with this particular trade, I've got to put a second entry in. Okay, so I need to be above that sell distance. So the reason I've put this in is you want your spacing not to be too big, but you also don't want it to be too tight. So this, for me, is set to 3/4 of an ADR, which is what I like to use on the hourly time frame. If you're trading 5 minute supply and demand zones or support resistance zones, you're not going to want to use half an ADR, 3/4 of an ADR. You might want to use 1/4 of an ADR, but you also will want to be doing your drawdown control a hell of a lot faster, because you could be in 4 or 5 positions in a day. Yeah, because you're trading chop on the 5 minute time frame, aren't you? So on the hourly time frame, that is a fairly decent move, and I might be in for a week or two, but we got a lovely area there. So this one here, if I want to be exact, and I'm going to be a supply demand trader, there's an accumulation of 2 hours there before the move started. I might want to take the 4 hours before it, which to me makes sense, because it's also this high here. Yeah, we reacted out of it with a 3-bar reversal there as well. So there's a bit of confluence. So I might stick my zone there. I've no idea. Maybe it could be higher than that. But what is important is that zone is a little trick there for the EA. If you just flick time frames, it automatically repaints it to the right. But it's above my next line. So that's fine. So if that doesn't work out, that would be the next area. But that's going to be, let's say we get a push up into there and a hammer, a shooting star, right? My entry is going to be there. That's going to be too close. So what I would do in that case is zoom out, have a look for the next area. Now, there isn't going to be one. So let's say, for example, I get in here. I'd then have to measure 906 from that entry, which would be about there. Yeah, above that high. So what I'd have to do is just stick a box up there. Yeah. So I want to keep my spacing roughly 3/4 of an ADR. But if there is an area of logical that makes logical sense, I'll use it. If there isn't, I'm just going to stick a box a bit above, and price will be stretched by the time it gets to that box and want to pull back. So you've got to keep your spacing. And you're right, there is the danger if you go, right, I'm only going to use the most recent highs and lows. The entry there to there is 1780, which is 1.5 ADR. Now, there's nothing wrong with you getting in here and saying, all right, I'm not going to get another trade on until 1.5 ADR, which is fine. If you are not paying swaps, it doesn't matter how long you're in the trade for, does it? You could sit in this for 6 months. It's not going to cost you anything. However, there is cost of doing business, and there is being in drawdown forever. grinding away at you and not being able to take any other trades on this. So it's about finding a happy balance between distancing and logical areas. Yeah, there's absolutely there is a reason for placing an order there. Yeah, because I've shorted this area already. This is why this trade is on, because I had a box here and it has come out of that area. Why? I don't know. I don't care. There's an accumulation there. It's popped through it and it's come back down, but it's working. So I'm in it. That's fine. Now, there's an argument for me putting a box here and saying, if we double top, I'll get in. But that's really close. So I could take a second entry there, and then my next entry, I will wait until I get all the way up there. Or I could put it there and have 4 positions on by the time we get up to there. But I have built this EA so that if price is below this line, when an order signal is triggered, it will not trade. So this is your sanity check for don't get in too close. Now, if you want to go, I don't care, I'm going to go 0.1. Yeah. I'd have to change instrument because it doesn't redraw. But if you change it to 0.1, obviously this is going to jump down to here. And you can trade wherever you want. You can get in there, you can get in there, you can get in there, then you can get in there. You can have 6 positions on if you like. But position trading methodology is about scaling in gradually, not about trying to get in and out as fast as you can. Because if you get in 5 positions and then tomorrow there's a news event which sends this skyrocketing, you're stuffed. Yeah. But if you get in 1 here and now wait and it goes skyrocketing, no problem. Yeah. Remember we covered on Thursday last week the 3 golden rules of position trading. Yeah. Size, spacing, exposure. Spacing is one of the key golden rules of position trading. If you get in too close, you will get killed. If you're getting too far apart, you will find it hard to get out. But if you're thinking about support and resistance, let me just change that back because I don't want. That's actually set to 0.5 because I'm testing, so I wanted it a little bit closer. But actually, no, it's not, is it? Was that 0.75 or 0.5? .75. That calculation isn't correct, is it? Oh no, sorry, risk settings. What am I doing here? Zone distance. Oh, that's a zone distance. Sorry, no, I was right. The minimum distance between entries is under risk. This is new to me, this EA. So yeah, minimum distance is 0.75, so not 0.5. Which instrument was it I was doing that on? Oh my God, what was I just trading, everybody? That one. Let me just make sure I change that back. Yeah, 0.5. So that's the box size, basically, the zone size that it draws in. So yeah, so you can have it as you want it. Yeah, but if you change that, let me just see if that does change dynamically on bar update. So let me just draw that line in. Yeah, it is only on candle. So this will update on candle close, not dynamically. If you have it set to on tick, it should update straight away, I think, when it ticks. No, I've made that work on no, I've made that work on ADR, I think. I might change that so that it works on close. I'm just trying to optimize it for the strategy tester. There's a happy medium between functionality and speed. And it's just trying to find the best way to update stuff that doesn't, slow it down too much. But, if I'm going to be trading that demand zone, see, for me, that demand zone could be any of these, but that is the logical place for me to put that, which is the high there before the break, the low before the break, but that's also encompassing that and that. Yeah. Perfect. But what might happen is my entry might be there, or rather my exit from this short, because I've got this on stop and reverse. When it gets down to here and triggers, it's going to automatically close my short and enter me long, because I've got it set on stop and reverse mode, which is always in mode. But if I set that to false, what will happen is when I get to that zone, it will just get me out the short, but it won't enter me long. But, we are saying this is where I think it's going to bounce. So I want to be long there. Yeah. So there's no reason for me not to exit and get back in long again. And you will be constantly in and constantly banking if you do that. But not everyone's going to want to do that. So there we go. CK, I am here but 12 minutes behind. How did you get back behind in the past? How did that happen? That's weird. There we go. So that's it. That's support, resistance, supply, demand done. This EA, I've got a problem with MT5. Funny that. MT5 in the back tester doesn't work, which is really annoying. So running the EA in the strategy tester. So obviously with this one, if I go into the strategy tester and run it, I can draw the zones. And this is the whole idea. When you're ready, you can draw the zones in and practice. Yeah, I can move them around, adjust them, do that, and move that one down to there, and that's the whole point of what we've been doing. And then it will draw the zones out and trade. Yeah. MT5, you basically go into the strategy tester and run it in exactly the same way. And I draw in my zone, and you can't grab it. It won't let you grab it. It won't let you do anything with it. Yeah, it's useless. It works absolutely fine, but you just can't use it in the strategy tester. Yeah, so the MT5 version is not for practice. It works here absolutely fine. Does exactly the same, no problem. But it can't be used in the strategy tester. Yeah. Very, very annoying. And the other thing I found out about this is, which is totally different to the way that MT4 works, which I've never really looked into or had to look into before, because I've never had anything that's drawn on the chart that needs to be changed regularly. But if I now switch from Aussie CAD to Euro odd, yeah, the zones have disappeared. But now if I switch back to Aussie CAD, the zones stay there. So when I go to Euro odd and go and look at the objects list, the boxes are still sitting there at those price points, which means that on the next candle close, this will trigger an order on the Euro odd, because it is below or above a zone that triggers an entry. On MT4, when you do that, and this is I'm struggling to find a way to get around this, to be honest, but on MT4, when you do this, if I place a sell and a buy, and you go into the objects list, you can see the buy and the sell box there. If I switch instruments those boxes vanish. So when and this all recalculates, yeah. So what happens in MT4 is when you switch instrument, everything reinitializes. It basically removes and re-adds the EA. All calculations are redone. Swaps are automatically calculated. ADR, ATR is automatically calculated. It deletes the boxes and goes, okay, let's start from scratch. In MT5, you look at the swap there, 0.02 and 1.72. If I switch to a different instrument, that doesn't change, that doesn't change, but that does change when it ticks. So there's a MT5, and I get it. I see, yeah, all right, I've drawn stuff on the chart, but if I switch instruments, I don't want that stuff drawn on the chart. It's a different chart. So yes, thank you for remembering when I switched back there, but if you've got an EA that trades off of boxes like this, it don't work. So with MT5, you can't change instruments. You have to open a new chart for every instrument. See, now it's gone long. It's taken a buy order. But the reason it took that buy order is because that Aussie CAD box, the price there, 0.51261, is below that buy box. So it's gone, hey, we've had bullish price action below the buy box. Let's get in. So I'm not sure whether I want to release it for MT5 because it doesn't work. It does work if you have a new chart for every instrument that you trade, which in theory, if you think about it, is exactly what you should be doing, because you should be having these boxes put in place and staying in place. Yeah. So if you're trading that and that, yeah, that is what you're trading. So you should now open a new chart with the EA on it and place the zones for that instrument on a different time frame. Yeah. So now I've got my odd CAD and I've got my Euro odd. But only one of them. So it works very differently. So I'm going to have to explain this because it's quite a key thing. Because if you just switch charts, switch instruments on the same chart, the EA is just going to trigger orders all the time. So I'm going to need to look into a way to try and either get around it or explain that's how it works. So use MT4. And also strategy tester, yeah, it's invaluable in the strategy tester. And if you can't use it in the strategy tester because it doesn't allow you to select drawn objects in MT5, useless. I won't go on about MT5 anymore. I'm glad I'm using the MT4, yeah. To be honest, as you usually say, in the end, no matter what condition we use to enter, I think the real edge we have is the fact that we use position trading and no stop loss to manage the trades. Yeah, exactly. You're never going to get the entry right. This is the thing. You know, there are traders out there who are absolutely phenomenal at technical analysis and getting in to trades. They're also very, very wrong. But the difference between them and most people is they have the mental capacity to just accept losses. And this is the bit that everybody struggles with, is accepting losses. And this is why it works so well position trading, because we don't accept losses. We do take losses regularly, but we don't accept them over and over and over and over again. And that's what kills people off. You know, this is why the system hopping methodology mentality is there. If you start trading support resistance, yeah, and it doesn't work, you go, screw it. I'm not trading that anymore. I'm going to try supply and demand. But you don't realize you're trading the same thing. You're looking for a turning point. Every strategy out there is trying to identify a turning point in the market. And they're trying to create an edge of more than 50% on a probability of 50%. You can't. It's always 50%. Yeah, you can back test and make it 70%, But every time you get to a new one, it still reverts to 50, which is why it's a zero-sum game using a stop loss. You always get back to break even, because no matter how good your back testing is, how good you curve fit, or what indicator you make fit the data you're testing on, in the future, the odds can only be 50%. Therefore, the only thing that you can make money with is risk, because that's all you can control. And if you use risk properly, with a risk-reward ratio around a 50% strike rate, you will make money. But you understand that risk incorporates 15 losses in a row, and then 22 wins in a row to give you the edge, because a 50-50 probability is going to have a lot of tails and a lot of heads in a row. That is a system that doesn't work until it does, but you don't give it the chance to get there, because you hop to a different system and apply the same edge of 50-50 to a new system. And it's a never-ending cycle, because it's never going to change the 50-50 probability unless they create a market that goes up, down, and at angles, i.e. the candle can close there and then the next candle can close here and give us an angle instead of just an open and a close above and below that one. We ain't doing anything different than 50-50. But it takes such a long time to understand it. And it doesn't matter how many times you go, it makes total sense. Some bloke, like, who is it? Somebody came up with a channel yesterday. I can't remember the name of it. But some bloke who uses the MACD, who's created an indicator that draws arrows based on a MACD, which draws a whacking great indicator arrow on the chart. And basically he trades a negative 1R risk reward on it. And he's got a great strike rate. But at the end of the day, it ain't going to work long term. And you'll see it and you'll go, this guy's just turned £400 into £200,000. Did he? Has he, just, you get this mist go over logic, and you chase the Lamborghini, don't you? That's what you do. But the maths is simple. You just apply risk around a mathematical equation. That's all you do. But if you don't have the mental capacity to take 15 losses in a row and stick with a strategy, change the price. So much easier. The logic behind it coming back up to this area. You've got to understand why that is likely to happen. Yeah, that's the thing. You've got to have confidence in the thing that's driving it is the banks, not the moon phases or something else. That's the hard bit. On telephone, you got paused on the telephone. All right, I see. With the support resistance EA, if I set up the boxes on my regular PC, will the EA running on a VPS pick up the boxes? No. No. You do this on a VPS. So this is running on my VPS, yeah. So what I'll do is I will come onto my VPS every day and I'll go, I'm long. I need to put a new buy limit in. Where can I buy it? That's a tricky one, that. But somewhere down there. Oh, I'm going to just stick it. And again, this is a great example. Look, there is no support. So I'm just going to stick it there, because I just want to get in again and get a bounce. CAD Swiss, I'm long. And this is the process of trading this way. Again, there's no support that is obvious. There's a little bit of a wick there. I'll pick that wick. It bounced out of there before, but obviously it could go all the way down there. But it's extended, so I'll try and get another one in, move the price down there, and try and get out if we get back up to there. So if, and this is how I how I always did it before I developed the EAs that work on indicators, yeah, is I will now get in here. Yeah, my average price will move to somewhere like there after taking a trade somewhere around there, which means that I will now put that sell limit box here. So I'll only make a little bit of profit, but then I will short it. Evil's got to go, that's fine. But that's how it works, yeah. So you you just basically do it on a VPS. If you shut your chart, does MT4 remember drawings? Yeah. Yeah. So if you shut your chart, MT4 remembers the location of the drawings. So you could shut it down at night, but obviously the trouble is by the time you open it up, let's say, for example, you shut it down here. If overnight prices moved up to there and put a bear candle in, when you open your chart, it will take a trade there and that will become a blue box because it uses these boxes. And if price moves beyond it, it will take its trade. Or it will invalidate the trade, depending on what you've told it to do. But yeah, that's basically how to use it. Very simple. Right, I'll leave it there. Anything else you need, let me know. I will be back tomorrow afternoon, and we will trade the New York session tomorrow. See if we can get on. I didn't look at the indices this morning, did I? What have we got? What have we got? Oh, a load of crap. Hedged on the FTSE. Downside target there. I'll try a bounce out of the previous day's low on the FTSE to the downside. DAX, clean break to the upside. I'm just going to move the stops to break even on it because it's trailing, because we got to 2R. That would have been a nice exit, actually. If I'd have taken that exit, we had a gap today as well, look. So if I'd have taken that exit there, that would have paid for the hedge, but I haven't. So I'm going to have to just hope that we get a continuation push on the DAX. So if we do get a push, that will pay for the hedge exit. Okay, have a good one. Anything you need, let me know. I'll be in Discord. I'm going to be working on the EA manual today. And then I'll let you know when it's ready. I've got to think about what to do with the MT5 version because it's going to be a problem. It's going to trigger orders if people switch charts, which it doesn't do in MT4. But anyway, I will work it out. All right, have a good one. Anything you need, let me know. Other than that, Discord or leave comments if you're watching on replay. Have a good day.